In 2022, the world's central banks bought more gold than in any year since 1967. Not private investors, not hedge funds, central banks, the institutions that hold the financial reserves of entire nations. They did not announce it in a press release. There was no global summit, no coordinated declaration. They simply bought, quietly, persistently, at a scale not seen since the year before the United States abandoned the gold standard entirely. Most financial headlines called it a portfolio diversification move, a hedge against inflation, a prudent adjustment to asset allocation. That explanation is technically correct. It is also almost entirely wrong because when you look at which countries are buying, and more importantly, which countries are selling, a different story emerges. Not a story about gold, a story about the dollar. For the last 70 years, the dollar has not just been America's currency, it has been the world's operating system. When a company in Vietnam buys electronics from South Korea, they settle in dollars. When an airline in Brazil purchases jet fuel, they price it in dollars. When a government in Africa needs to import medicine, it first needs to acquire dollars. This is not an accident. It is architecture, built deliberately after the Second World War, reinforced by the petrodollar agreement in 1973, and maintained by a network of institutions, alliances, and financial infrastructure that took decades to construct. But architecture can be rebuilt. The 53 central bank gold buying that began quietly in 2022 is not about the metal. It is about what the metal represents. A way to hold national wealth that requires no trust in Washington, no compliance with SWIFT, and no exposure to the one weapon the dollar system uniquely enables: sanctions. Russia in 2022, Iran for decades, Venezuela. These are not just geopolitical cautionary tales. They are proof of concept. Proof that if a country sits inside the dollar system, its reserves can be frozen, its trade cut off, its economy strangled, without a single bomb being dropped. The gold rush is the world's response to that proof. Now, for the part most explainers get wrong. This is not a story about anti-American sentiment. It is a story about risk management, and the countries doing it most aggressively are not America's adversaries. Some of them are its closest partners. India. India now holds more gold than at any point in its post-independence history. But the gold is only part of the story. Simultaneously, India has been building rupee-denominated trade settlement with Russia, the UAE, and several African nations, not to destroy the dollar, to reduce exposure to it, to ensure that if the dollar system becomes a political weapon, India has an alternative architecture already in place, already tested. The rupee trade framework is imperfect, it is limited, but it exists. Turkey. In 2019, the United States threatened sanctions over Turkey's purchase of Russian missile systems. Ankara responded not by backing down, but by accelerating gold accumulation and engaging more deeply with China's parallel payment network, CIPS. Turkey is not leaving the dollar. It is building a parallel position, a hedge, a seat at two tables simultaneously. This is the strategy being replicated across the emerging world, not replacement, redundancy. Saudi Arabia, this is the one that matters most. The petrodollar agreement, the foundational deal that has underwritten dollar dominance since 1973, was built on a simple premise. Saudi Arabia prices and sells oil in dollars. The world needs oil, therefore the world needs dollars. In 2023, Saudi Arabia confirmed it was actively discussing yuan-denominated oil sales with China. It did not announce that the petrodollar was ending. It announced that the petrodollar now had competition. For a system that has operated as a monopoly for 50 years, competition is not a minor development. It is a structural change. Southeast Asia. ASEAN, the 10-nation bloc anchoring Southeast Asia, launched a local currency settlement framework specifically designed to reduce dollar dependency in intra-regional trade. Malaysia, Indonesia, Thailand, and the Philippines are now settling increasing portions of bilateral trade in their own currencies. This is not 47 de-dollarization in the dramatic sense. It is de-dollarization at the margins, quietly, persistently, at a scale that compounds over years, not months. But here's the counter argument, and it is strong. The dollar's dominance is not maintained by goodwill. It is maintained by network effects that are genuinely difficult to escape. Consider three things that reinforce each other. First, depth. The US Treasury market is the largest, most liquid financial market in the world. When a central bank needs to park trillions in reserves safely, there is no comparable alternative. The euro market is fragmented. The yuan is not freely convertible. Gold does not pay interest and cannot be deployed at scale in a crisis. Second, inertia. Global trade contracts, derivatives, commodity prices, and shipping invoices are overwhelmingly denominated in dollars. Changing this requires not one country deciding to switch, but thousands of businesses in dozens of countries simultaneously rewriting their contracts, systems, and relationships. Third, trust. A reserve currency requires something deeper than liquidity or convenience. It requires that foreign governments and investors can hold it freely, move it freely, and trust that the rules will not change. For all its flaws, the dollar still offers this more reliably than any $54 alternative on offer today. The countries accumulating gold know this. They are not betting that the dollar collapses. They are hedging against the possibility that American foreign policy makes the dollar too costly to rely on exclusively. That is a fundamentally different thesis, and it is accurate. Here is what is actually happening. The dollar is not losing its reserve currency status. It is losing its monopoly on the infrastructure of global trade. These are not the same thing. The dollar at the center of the global financial system is not being dismantled. It is being surrounded slowly, carefully, by alternative settlement mechanisms, alternative payment rails, and alternative stores of value that reduce the cost of exit if exit ever becomes necessary. Central bank 50 gold reserves are the clearest signal of this shift. Gold cannot be sanctioned. Gold cannot be frozen. Gold does not require correspondent banking relationships with New York. Gold is, in the precise technical sense, the one financial asset that exists entirely outside the dollar's reach. The countries buying it are not doing so because they expect gold to appreciate. They are doing so because they are building optionality. The option to operate in a world where the dollar is one choice among several rather than the only choice available. In 1944, the United States created the dollar-centric financial order because it was the only country with the economic weight to anchor it. That was a structural fact. What has changed in the 80 years since is not American power. It is the emergence of enough economic weight elsewhere, in China, in India, in the Gulf, that the structural fact no longer holds with the same force. The gold rush is the world pricing in that change. Not quickly, not dramatically, but persistently. The question is not whether the dollar will be replaced. It will not be, not in the next decade, and probably not in the next two. The question is whether the dollar will remain the world's only option, or whether it will become the world's best option in a system that has learned to build exits. That distinction matters, because a monopoly and a preference are maintained by entirely different forces. A monopoly needs no competition to survive. A preference must earn its position every day. For 70 years, the dollar has been a monopoly. What the central banks buying gold are quietly building is the infrastructure to make it compete. The question is not whether that transition is coming. The data says it already is. The question is how far it goes, and whether Washington gives the world more reasons to hurry.